Hello, welcome everybody. My name is David Postolsky. I am an intellectual property and patent attorney at Gearhart Law. We are which we're based in Summit, New Jersey. We put on what's called the Entrepreneurial Strategy Series. We do it every month. It's usually the last Thursday of the month at 12 p.m. Eastern, but due to the holidays, we decided to make it a little earlier in the month. But we have these every month, and if there's a particular topic that you might be interested or want to hear more about, let us know. We're looking always for topics and provide speakers that are talking about their journey from concept to exit. And so I am super thrilled to have our two speakers today, Kevin Muno and Chris Rawley of Harvest Returns. They have been sitting in listening to all of you. So I'm glad that they came a little early to get a sense of who's on the call. Welcome again, everybody. I'm going to let the speakers introduce themselves. This session is all about crowdfunding, mostly equity crowd financing, as we call it. We'll talk about, Chris and Kevin will talk about some of the differences so that some of you can be on the same page. We're not going to assume that everybody knows everything. And again, this is being recorded, and we will share the recording probably in about a week with the contact information of Kevin and Chris, our speakers, as well as some other information that might be very helpful to you. So without further ado, and they've been waiting very patiently, thank you, Chris Rawley of Harvest Returns. Please introduce yourself a little bit. Tell everybody who you are, what you're working on, what you've created, and we'll start there. Thanks.
All right, thanks, David. Great to be here with you, and great to be here with this audience of entrepreneurs and talented, wonderful, creative people. I want to talk. We're going to get into crowdfunding, what we do, but myself, I have like a lot of entrepreneurs. I have kind of a diverse background. Didn't start off right away owning a company, but I think I've always wanted to do that, starting and running a company. It's kind of been in my DNA, you could say. My father was an entrepreneur as well as his father, and so it kind of goes back in our family. I am in Fort Worth, Texas now. Grew up in Texas. Do not have a farming background. You'll see that that's actually the space that I'm in now, and it was kind of a long journey to get to where I got. But the quick answer is I was in the military for quite some time. Traveled around the world, a lot of places. Visited places where people don't take their food system for granted, like we do here, I'd say, in the United States, where we have instant access 365 days a year to any food that's in or out of season, because our food system is very globalized right now. And visiting these war-torn countries that were, in many cases, impoverished. People had to grow their own food or buy it at the local farmers market. Started to give me a greater appreciation for food. At the same time, I've always been fascinated by investing, and I've invested in just about anything one can invest in, including stocks and bonds in the publicly traded market. But I became more and more interested in investing in a more streamlined manner. And so early 2010s or so, found out about this thing called crowdfunding. I'd been investing in real estate for some time, that there were these platforms springing up that enabled somebody to invest in an apartment building or a house by just pressing a couple of buttons and transferring funds. And I thought, this is amazing, because I've done this. I've invested in real estate, and it takes a lot to do that. It takes a lot of knowledge. It takes a lot of legal stuff and steps and paperwork and time and due diligence and all those things to do a good investment. And here were platforms that enable just sort of the average person to do that. So in 2016, we started up this company, Harvest Returns. And what we do is we help farmers and ranchers and people in agricultural related businesses to raise capital. So we've raised about $40 million. We're a Reg D platform, and we can get into what that means, I think, in the next section. But right now we work with amazing people, farmers from all over the country. And the guy you're about to hear from is one of those farmers who we've worked with. And I guess I'll let him get into that. Thanks, David.
Thank you, Chris. We're truly lucky to have a platform here. But yes, you are you are one of us for sure. You started, you are an entrepreneur and we're a startup. So thanks for sharing that part of your story as well. Kevin also waited very patiently. Thank you for sticking around for the first part. Um, please tell us who you are and how you met Chris and what you're doing here.
Perfect. Yeah. Thank you, David. Thank you for having me. And Chris, thank you for the invitation to come on here. Definitely with kindred spirits. I love talking all things entrepreneurship and investing. And I'm a firm believer that entrepreneurs are really the foundation of our economy. They're the risk takers and the value creators. So it was beautiful hearing all of you this morning share your stories about what you're doing to go out into the world to help other people and make the world a better place. So, my name is Kevin Muno. I'm the founder of Perennial Pastures Ranch. We are a regenerative ranching operation based in Southern California. We had a successful raise on the Harvest Returns platform with Chris and his team, and to date, we've raised close to $4.5 million of equity and a good chunk of debt too. And so what we do is we do a few things. We ranch ourselves. We ranch 16,000 acres here in Southern California and produce beef cattle regeneratively. If you haven't heard of regenerative agriculture yet, regenerative agriculture is all about healing the soil. It's about mimicking nature with your agricultural practices to enhance ecosystems and build ecosystems and produce nutrient-dense food as you do that. So in our case, in a ranching scenario, we graze our cattle in a way that mimics the bison herds that used to be here in America. It used to be about 30 million bison here in America, and those herds would move together in one herd across the landscape, and that intense grazing and long recovery periods is what has built um, the world's deepest topsoils. I don't care what country you're in, whether it's the Serengeti in Africa or the deep soils of Ukraine or the Midwest here. I saw somebody was from Champaign-Urbana. I've been there, and beautiful deep soils. Those soils were formed through animal agriculture. And so we currently have a direct-to-consumer beef business. We sell beef as well as lamb, chicken, and eggs. We're in farmers markets here in Southern California, about 16 of them. And we are looking to grow our direct-to-consumer business, and we're currently on pace to hit about 3 million in sales this year. And there's a lot of traction that we have. Regenerative agriculture is very popular right now because you might have heard we have a bit of a chronic disease epidemic in our country, and so we're looking to make people healthy again, and it starts with the soil, and it starts with nutrient-dense food. So thanks for having me, David. Excited for the conversation today.
Awesome. Thank you, Kevin. We'll come back to you as well. Let's set the stage a little bit, Chris. Maybe you can talk, and Kevin, you can jump in here as well. But Chris, maybe you can kind of just give a little bit of a brief, maybe background on some of the terms that you said, equity crowdfunding, Reg D, maybe talk a little about the Jobs Act, maybe just give people an understanding of like, what is equity crowd financing? And, I think most people know about Kickstarter, which is reward-based crowdfunding, which is, you're raising money in exchange for in exchange for getting some sort of like, pre-sale of something or a gift of something or some sort. So maybe you can kind of talk about that a little bit. And Chris, I think your video went out actually. Hold on one second. Chris. Chris, are you there?
He's on mute.
Yeah, and he's on mute and his video went out. Hold on a second. Hold on.
I can text him.
Yeah, let's text him. I think he may have
I
to.
can can do my best at picking up that question too.
Yeah, I think maybe if you can do that while we wait for Chris. So yeah, so just and I'll add a little more color to that as well.
If you want to
Um,
do the legal part on like the Jobs Act, I can tell
y-
people how we raise money on the Harvest Returns platform.
yeah, let's do that. So so the few types of crowdfunding that are out there, we talked about reward-based crowdfunding, which is like Kickstarter. You've heard one or two people have used that, where it's almost like a pre-sale of your product, where in exchange for the money that in exchange for asking people for money, you are taking that money and then developing or manufacturing the product that you'll then give to them. And so they're like early adopters or first adopters of the actual product, but that doesn't involve equity. People are just literally giving it out of the goodness of their heart in exchange for the product. Um, about when President Obama was, so how long ago was that? Could be about 20 years ago now. He created something called the Jobs Act, which was the Jumpstart Our Business Act. And it was a way that now allowed people to raise money using the internet. So that's really what it was all about. And so now you were able to raise money using the internet but you had to kind of fulfill certain obligations. There were different regulations that was part of the Jobs Act. In the beginning, the Jobs Act required that in order for you to raise money, meaning offer equity in exchange for money online on a platform like Harvest Returns, you'd have to be what's called an accredited investor, meaning like you'd have to be an investor that was educated, that had a high net worth, that really kind of knew the risks, because the whole idea was that, in the beginning, only investors were deemed to know the risks of, investing in companies that they never knew anything about, that they were now seeing on the internet. And so that's kind of how it all started with equity crowdfunding. And there's a lot of platforms like that. A lot of them are very niche, and a lot of them deal maybe like in different, like in like consumer product goods and agriculture. There's all sorts of different platforms. Um, but that then kind of morphed into other ways to equity crowd finance. Again, raising money, so granting equity to someone in exchange for their investment on an online platform. Kevin, maybe you kind of take it from there.
Yeah, and actually I've done both. So when I first started my farming and ranching operation, I did do a Kickstarter. I think
Oh,
I
you
raised
did.
like
Awesome.
25,000. Yeah. That was just
How
kind of
did that
get
go? Yeah, if you can talk about, if you talk about that a little bit, that would be good to think also, if you can.
Yeah, like I'm trying to I hear a lot of folks, struggling with fundraising on in the networking section, and it's taken me, I want to say 8 to 10 years to be where I'm at now. I'm 36, right? And agriculture is a tough, industry to fund. There's just not a ton of margin. I heard a lot of tech companies there, a lot of real estate, some other interesting ideas. And so, if you're having trouble, Kickstarter is a good way to go. It's family and friends. It prepares you for raising money. You have to get your ideas together and your business model and your thought processes, and film a short, punchy video that people really grasp onto, right? Kickstarter is all about momentum and virality. And so you want to kind of work with bloggers, with folks, influencers that have big audiences, and you want to really get the first few days of your Kickstarter deal going. Like first few days you're listed on the platform. If you can get to like 50% of your goal, whatever goal that is, I believe Kickstarter enhances your chances. It promotes you within its own channels, and features you on their website, which has a lot of followers, and on their social media that has a lot of followers. So if you're trying to do it, there's a little bit of ways to kind of game the system. Maybe you pump some of your own money in, and then you can get some other money from other people too. And again, that's all rewards based. So, we did things like t-shirts or pre-sold product or things like that. So really good, low risk way to kind of get started, whether you're just, doing more due diligence for the idea or what have you. You can be very honest on the platform and do that. But I've heard companies raising hundreds of thousands of dollars on Kickstarter. Again, I think we raised about 25,000 at the time. So that was the start. 25,000 is not going to get you very far in the world of agriculture when you have to buy land, equipment, and get things going. So my next raise was actually not a big, much larger. It was about 420,000. That was just family and friends. Again, we bought a piece of land with that. I was able to exit from that a year after my lease failed, and so I took the capital from the land sale and gave those investors back, and that's who I rolled into my newest deal. And so I brought that successful raise into my new fundraise, which I started raising money in 2020, right during the pandemic. So I actually might have hit it pretty good because people were probably thinking a lot about food and where their food's going to come from and resiliency during that time. So investing in a local ranch or local at the time was probably something that they were interested in. And so I raised money from family and friends. And towards the end of that round, that's when harvest returns came in. And I said, look, hey, I've got 300 to 400,000 already committed. You know, I need a little bit more growth capital to do what I want for improvements on the land and to finance cattle and things like that. So I put together my pitch deck. I put together my good financial model that showed all my projections, you know, income statement projections, balance sheet projections, cash flow projections, and really knew my numbers and felt confident enough to go out into the space. And Chris and his business partner Austin were great. We had a few calls and a few presentations to his network on harvest returns, and we were successful in raising 425,000 on the harvest returns platform, and that was a big chunk for us, you know, at the time. And so we took that family and friends money and the money that we got from harvest returns, and that really lasted us, you know, a good 2 to 3 years as we started the business up and bought cattle and got things going, got farmers markets and got traction, right? And then more recently, we're able to close a $2 million investor on the back of that because we had traction and he saw the potential, and we were just finishing up a $1.2 million sales year in 2023. And so that's kind of the stage of process, you know, from Kickstarter to a little bit higher of, you know, 400,000 to a little bit higher of, you know, 1 million to a little bit higher of 2 million, right? So we've had a series of fundraising rounds as we've gone through the progression of this business.
And Kevin, I think Chris is back. Chris, are you with us
Yeah, can
or
you see me?
I don't
Yeah,
think
I could see you.
I can
Yeah, I'm here.
Hey Chris. So
So my supreme apologies. I think I had too many things going on my computer at once and blew up the system. But I am ready to talk about equity crowdfunding. Appreciate Kevin jumping in there and telling about
I did my
kind of his
best,
journey
Chris.
to
I did my
raise.
best.
Yeah,
David
so
did touch on
equity
a
cra
little bit of the jobs stuff, the
yeah, I talked
Jobs
about
Act and
Jobs
stuff.
Act and stuff, but
yes,
maybe we can hear it from your because you are
yeah.
the
So
platform, you know.
the Jobs Act, I believe it was 2016. It's been revised a
2016.
couple times since then. Is sort of what set the stage for U.S. based crowdfunding. And what I'm going to talk about is U.S. based. There are similarities if you're in another country. Of course, you've got your own regulations there, so you need to look into those. That said, it is possible for companies outside the United States to raise capital on a U.S. based equity funding platform. Some of them, not all of them. So essentially, what the Jobs Act did was make it viable for companies to bring the crowd in to take an equity stake in their company. And there's several flavors of regulations related to the Jobs Act, and they all have different. Yeah, you definitely want to talk to either a crowdfunding platform to get the details on these or a securities attorney to better understand them. But the similarities, they all have limits on the amount you can raise. So you'll hear something called Reg CF, which is kind of the pure form of crowdfunding, I guess you might say. You're able to take up to raise up to $5 million. You're able to solicit publicly. So you'll hear the word solicitation a lot. That's who you can actually raise capital from. Not every type of crowdfunding can raise capital from every type of investor. You'll also hear Reg A plus. That's a different kind of capital that allows retail investors or those average everyday investors who might have $200 or $500 to come in. And then there's the kind of crowdfunding or syndication that my platform does. We use Regulation D. It's an SEC, Securities and Exchange Commission exemption. 506B is a thing you're here, or 506C, and they all have their differences. But the most important thing is not to like understand all the intricacies of that. That's what securities lawyers are for. It's to understand that there are some restrictions on what you can do, and you can't just go out and throw up a website and raise capital and do that in a compliant manner. And that's really where these crowdfunding portals and platforms come into. And that's kind of the overview of equity crowdfunding. And there's different type. You can raise pure equity into your company, so people take a share of your company. There's revenue sharing models. There are debt, pure debt, and there's peer-to-peer debt. That's a form of crowdfunding. We do convertible debt, which is one of the types of raises we do with early stage companies, especially on the when a company doesn't have a valuation. So you want to raise money, you don't know exactly how much your company is worth. Convertible debt may be one way to do that. And then the pure equity is kind of your typical, if you've ever watched Shark Tank and people negotiate for values and percentages of the company, that's essentially equity crowdfunding. So it's a big wide world. I'm happy to talk, and I think we're going to talk more about like different types of crowdfunding platforms and portals and how to choose one. David, is that the
Yeah,
next topic?
Chris, if you can actually get into that, because there is
Yeah,
a whirlwind of a lot of platforms. There's a lot going on there. Reward, equity, within equity, there's niche ones. So like, how do you choose one? If you can break some of that down, that would be great.
yeah. So um, I think at last count there are over 1,000 different crowdfunding platforms in the United States, and there you can, mine is niche. We're in agriculture. There's some other platforms that are similar. Wouldn't call them competitors, but similar to us, that raise in the agriculture spectrum. There's generalist platforms. There are You can raise for like fine wine. I've seen there's platforms for fine art. There's platforms for lawsuits, like negotiating lawsuit outcomes. There's platforms, you name it. There's probably a crowdfunding platform that is focused on the type of company you're doing. And there's these general large scale platforms. So some of the big Reg CF platforms you might hear are ones called WeFunder, Start Engine. Those are the two big ones. Dealmaker is another one. There's some other ones. There are some that are very focused on real estate. So if you have a real estate project, there's probably a niche platform for you to raise in a real estate oriented projects. And what the platform you choose is if you're considering raising capital this way, that's the first thing you've got to do is research a little bit about what platform you want to raise capital on, and that depends on a number of things. How much money do you want to raise? If you want to raise in the tens of millions of dollars, you're probably, and it's your first raise, you're probably need to manage your expectations a little bit. There is as Kevin explained, there is a sort of incremental approach to raising capital. In the technology side, it's very that model was built in Silicon Valley, and so and with the venture capital firms, but that same thing applies to crowdfunding platforms where you've got like a pre-seed round. So that's when maybe you just have an idea, a team put together, very limited traction. Maybe you might be pre-revenue. There's a seed round where you've kind of proven your model. You've got a minimum viable product or service. And then the typical names are Series A, B, C, D, E as company grows larger. That doesn't always apply on the crowdfunding platforms, and I would say even today it's not even as applicable as it was just a few short years ago in the VC world. So one thing I'm going to say, it may sound a little bit counterintuitive, but not every company is investable. You'll hear that a lot in a VC world, but I personally think that there is an investor for every company. So you may not be able to You may say, oh, I've got a tech company, an idea. I want to go out and raise, venture capital money. Well, for whatever reason, your company may not be appropriate for venture capital. Maybe it is appropriate for crowdfunding, or maybe it's appropriate for that, that friends and family round that typically comes first, or some other form of funding. So don't get wrapped around. Well, the thing about being an entrepreneur is not to give up. So if you're trying to raise capital, even if you approach a crowdfunding platform and they say, yeah, this is not going to work for us, that doesn't mean you're not able to get funding. It just means you're not able to get funding from that specific platform. So you may want to try a different one.
Excellent. Thank you, Chris. And we'll come back to Kevin. So from your point of view, what did you consider? Like, what type of due diligence did you do to choose harvest returns? I know it's very niche, and maybe that's what was the ultimate decision. But what went into your kind of strategy in choosing harvest returns?
Yeah, like Chris said, Harvest is one of maybe, five big platforms in the space. I think it was that, the team, the founders, Chris himself and Austin are just great people, and they really care, about every single business that they're trying to raise money for. They also do a lot of kind of different types of deals with different sort of securities offerings. Some of the other platforms are really just more land-based focus, or they have a very narrow scope of securities that they offer, and meaning, that their investor base too is probably very narrow and less diverse. So it seemed like, Chris and Austin had a very diverse investor base, which ours was an equity deal, Reg D, and we have a waterfall structure in our equity um, uh, offering, and so it just made a ton of sense for us, and they were, right place, right time. We had some traction, and regenerative agriculture deals are still very, popular and hot, and so we're just, I think, right place, right time, and we're able to have a successful raise.
Awesome. And then along those lines, Chris, is there a type of company that approaches you or applies to the platform that you don't accept on the platform? And if so, why? Like, are they just not ready? They're not organized. They don't know what they're doing. They've never, done this before. Because I think there's a lot of early stage people on the call right now that think that they might be ready for, millions of dollars. There's that, and really that's not the case always.
Yeah. So the readiness is very important. I will say, if you, at least for us, if you never raised capital before, that's not an obstacle. We have been what we call first check. We've been last check. We've had companies that have venture capital investors, and we finish out a round. We have other companies that are just farms and ranches. A little bit earlier than Kevin was, that were able to raise capital for us. So for us, that's not necessarily an obstacle. But being ready, what does that mean? So you have to have a firm grasp of your numbers. Um, and what I mean by that is, if I say, hey, give me your pro forma 5-year projections, and they kind of scratch their head, that's a problem. Now we happen to have some partners, and there's some other ways out there that, if you're not a finance expert, you can have somebody else help you with that. Just as you're not an expert in intellectual property, you can go have David and his team help with you with that. But things like that are very important. Um, the team itself is something that we look at very carefully. So we have farmers in particular in our niche that are really good at farming. Maybe they're like a third, fourth generation farmer, but they don't have that business acumen or the financial acumen. So that's a problem. Now, they don't necessarily have to be that jack of all trades person, but they do have to have somebody on their team that knows those things. And when I say team, that doesn't mean they have to be your employee, but you need an accountant or a bookkeeper. You need an attorney. You need somebody that understands sales or marketing, even if they're not necessarily working on your team. All these basic business sorts of skills are important. If you're a one-person show, um, that's going to be harder for you to raise outside capital from investors. So that's something to think about. I want to talk about red flags. So when somebody comes to us, uh, there's some things that we call red flags that are not always red flags, but they can be. There's certain words that you need to be aware of when you talk to people that want to risk their money on you. And one of those things are, I need money now. If you need money now, it's probably too late for us to help fund you. This is again a long-term thing. Even though the actual raise, like we can raise money in a couple of weeks, 3 weeks. If you have a really good deal, we can raise hundreds of thousands of dollars or more. And we've done that before. But that doesn't happen instantaneously. The preparation for that is our part, for our part, the due diligence, for your part, all the preparation that goes up to even approaching us to make a successful crowdfunding raise. And Kevin mentioned some of those things. So needing money now, it sounds more like desperation to our investors. So that's not good. Another one that people aren't going to like this, but I'll say it: a serial entrepreneur. If you come and you tell me you're a serial entrepreneur, that can be a red flag. It's not always, but it can be, because what that tells me is you don't have the attention and focus and wherewithal to stick with a business through an exit. And for investors, so let's talk about investing from your perspective. And I'm saying this from an entrepreneur's perspective, some of the folks on this call, but also from mine, because I've been there, is I need money. Okay, great. You need money. From an investor's perspective is I have money. I have many choices where I can apply that money. I can dump it into my 401k, into the S&P 500. I can dump it into a securities or U.S. Treasuries or something, a certificate deposit, something that's 100% safe that may make me a smaller yield, or I can invest it in a startup company, which is probably some of the companies on here. That latter option is very high risk. So there's a chance that the investor could lose all their money. Unfortunately, we've had that happen to some of our investors on some of our portfolio companies. It can happen. So most of these investors, especially if you're an accredited investor, which means you're doing a Regulation D investment, you have a level of sophistication, you have a level um, of means, you have $1 million or more in investable assets or certain income thresholds. So people like that, they want to invest their money, but they want to do it smartly. They want to support startups. They want to support something they're passionate about, be it regenerative agriculture or some new technology or some social impact. That's great. There's investors like that, but they also want their money back. They don't want to lose money. Nobody likes to lose money. So if you come to me and say, and you're not aware of the investor perspective, that's going to be a problem. If your projections are not realistic, that's going to be a challenge for us. If your valuation, if you're a equity company, is not realistic, we're going to have a conversation about that. In our particular model, we will put up valuations that are unrealistic, but we will also, give the caveat that you're not going to raise a lot of money, or you may not raise any money because you chose an unrealistic valuation. So an introspective attitude is important when you're in a humble attitude when you're raising money. You may have the best idea, you think you got the best team, you've got super traction, but other people may not think that. So one of the things that we like to do is provide honest feedback. And when we're talking to companies that come to us to raise capital, sometimes we give them that feedback. They don't like it, but we hope that they at least learn that there's some things you can do to raise money, and it's important. So there's a lot of different aspects of this. I'll stop and see if anybody has questions about that.
Chris, there's a lot of great nuggets in there. Thank you for all of that. Kevin, from your angle, Chris talked about readiness, and kind of what that meant. And so how did you prepare for that? It sounded like you had friends and family, which are not, I mean, there are investors, a type of investor, but this would Harvest Return offered something a little bit different from an accredited investor point of view. How did you get ready for that mentally, financially, from a company perspective? How'd that shake out for you?
I think it took me a long time. I graduated business school from University of San Diego in 2011, and you hear these stories of, tech entrepreneurs at an early age going out and, raising capital. But in my industry, there's not a known funnel on how to, necessarily go out and raise money. I think in certain industries, there's a path that you follow, and it's very defined, and there's lawyers and accountants and people that can help you do that. I had to kind of go out and figure it out myself. So a lot of trial and error, to be honest, a lot of failure, some lucky successes in terms of when we bought that piece of land on my $400,000 raise. Just so happened the guy who bought the surrounding ranch, I had an easement that went through his ranch, so my 80 acres went up in value, by the tune of about 100 grand in 1 year. And so I was able to kind of exit from that, even though my other lease failed, and I was able to take that money and kind of go in. So in terms of getting ready, feeling ready, I think you have to know that you don't know it all, but at the same time that you've been through enough failure to know that you have it right sort of this time. And when I approached Chris, it was really version 3.0. I had, a Kickstarter little, ag project that I did, and then I had my previous lease that I did, and then this was okay. I've learned from some of the best regenerative ranchers in the world. I've gone out and invested in myself, probably to the tune of workshops and seminars and conferences, maybe. I don't really know the exact number, but it's probably north of $100,000 in training and time that I spent in this field and career to go get ready. And then I finally really got a good grip of the financial, area. And there's a book that I read. Full disclosure, the only class that I didn't do well in college was accounting. I got a D in it, and I couldn't figure out T accounts. I was just like, why do I have to know T accounts and debits and credits, and but I just couldn't get how those things would balance. And come to find out, there's a thing called QuickBooks, which just does it automatically for you when you're an entrepreneur after you get out. But once I learned how the three financial statements connected and how they actually worked, and what a balance sheet, income statement, and I'll make a differentiation between the indirect cash statement and the direct cash statement. Most people don't understand cash flow statements because the indirect one has income statement accounts, balance sheet accounts, and cash accounts on it. The direct cash statement is all just a summation of direct cash accounts. So you have your operating cash flow accounts, your investing cash flow accounts, and your financing cash flow accounts. And the cash statement was only legally mandated on the Accounting Standards Board, FASB, 1987. It's about as old as I am, about 36. And so it's the newest financial statement. So really understanding that, and that's what investors care about, is how you're going to get to that cash and how you're going to get their money back in return. And so just knowing those numbers through and through, and every model is just a guess really at the start, especially if you don't have a track record. But the ability to modify that pro forma as you go, and use it as well to help you make decisions on what you should invest in, and what your cash runway is, and what your overheads are, and what your gross margin is to cover those overheads and things like that. So you just really got to know every single piece. So two books I'd recommend: Managing by the Numbers. It's an older book. Chuck Kramer wrote it, but it profiles this guy, Lou Mobley, who was a executive business coach at IBM back when IBM was Apple Computers. Super simple book, very small, but it talks about the financial scoreboard. And Lou Mobley and Chuck Kramer created the financial scoreboard. And for me, it's a software thing that connects all these statements and puts it together. And once I realized that all those statements connected, my mind just completely expanded, and I can answer pretty much any investor question that is out there, because most investors, even sophisticated ones, really only understand cash. But when you can go into balance sheet questions and income statement questions and even complex tax questions, it's very impressive to those investors. And so that's one book. And then we've implemented a system called Traction, or EOS, which is Gino Wickman, and I think every business needs to have an operating system. I'm a visionary type, and I've had to be the visionary and integrator kind of for this company for a long time, and still am. But if you can build a structure around yourself where the visionary can do visionary things, and you have a really good ops person that can handle the day-to-day business and be responsible for the P&L. That's a pretty mean combo, and there's a lot of successful companies that have employed that model. So those are two books that I'm recommending to entrepreneurs.
Kevin, excuse
Uh,
me, please, for interruption. Could you please type it in the chat? So several guys are asking also,
yeah, sure,
so we can Google. Thank you. Sorry
of
for
course.
interruption.
Yeah, no worries.
Thanks, Anton. Thanks for that. Yes, I highly recommend the EOS system too. We do it at the law firm as well. Every kind of business should kind of adopt something like that. Kevin, can you talk a little bit about your interaction with the investors that invested through Harvest Returns and like kind of what that looked like? What was the mechanics of that for you?
I guess one nice thing and a part of the service that the equity funding platforms provide is they do all the investor management. I was kind of a hybrid where I raised a chunk just directly myself, and then Chris and his team kind of finished it out. And so I do direct investor relations. I wish, I had the ability to just do everything through Chris, to be honest, because investor relations is a whole side of the business in and of itself. And so the way it works with Chris and his team is we do quarterly updates, and I'm getting better about those. I haven't been great on them, as Chris knows, but you're juggling all these things, and you're trying to just run the business and make sure that that's successful and surviving, really, especially in today's economy. And so that you're sometimes you're safeguarding their money, and reporting to them can be sometimes lower down on your to-do list, let's say. But the nice thing with Chris and the service that he provides is you're not having individual people call you. So I think there's like 15 plus investors that Chris aggregated, and he's kind of the funnel for them to approach me. And we're starting to move more into kind of a direct, model where maybe they can ask some direct questions through like a webinar platform. I think what you don't want to get into is a situation where it's just like a free for all. You want that feedback and communication sort of structured and funneled in a way, because you can get into a scenario where investors start telling stories to one another or whatever, and I think that can get a bit messy in terms of investor relations. So Chris and his team have guided me on that, and we do have our first kind of yearly update where we're going to do a web Zoom call starting in January. We're going to review all the financials in depth, and then he's going to kind of moderate the questions, and we're going to answer questions. But I think transparency and just good financials and all that is key to, and honesty is key to the investor conversation. Our initial projections were probably earlier sort of distributions, but we found a way for kind of more growth, and maybe a pop more so at the end, instead of like kind of consistent distribution. So that's what we're going to tell the investor group, and that's part of the being the life of an entrepreneur, is you see market opportunities that didn't exist when you first started out. And we're seeing that this regenerative agriculture space is much larger than we anticipated, and we're actually first movers in it, in a great area in the country that people value regenerative agriculture and healthy food and healthy soil. So we want to kind of be first movers, and perhaps go for a little bit more growth and sacrifice a little bit of profit in the meantime, for a larger exit for those investors in the end. So that's kind of how things have shifted, and how we look at investor relations, and how the equity crowdfunding platform can help you do that.
Awesome. That's great. I mean, Chris, if you can comment on that, because that's very different, right? Than like, working with a VC or going through an accelerator where you yourself are integrating, the entrepreneur themselves is directly talking to the investors and there's that fiduciary duty that requires weekly meetings or whatever. But it sounds like through the platform, it's structured a little bit different. If you can comment on that, that'd be great.
Yeah, I'll talk about that in investor relations in general. So, as Kevin said, we manage, that's kind of one of the bonuses or services we offer companies that raise capital with us. We want to deflect all those random questions at random times when their company's out there trying to execute, that those could be a distraction. And I've got the investor relations team to take care of those. And so this is going to vary wildly by platform. On a Reg CF platform, these are the retail investors where you may have hundreds and hundreds of small investors, and so you need to understand that before you raise money on one of those platforms. How is investor relations handled? Because if you've got 200 or 300 people, there's always going to be somebody that's not happy when you have a pool of people, no matter what the situation is, customers, a pool of customers, and investors are your customers. So there are some reputational risk involved with doing something like that. People can post the internet has made it very easy to broadcast unfavorable views. And so if you treat your investors unfavorably, there is a risk that they're going to get loud on social media or otherwise. So that's something you need to think about as someone taking investments from, especially retail investors. Managing, updates, and what Kevin said is absolutely essential. Transparency. Investors would rather hear bad news sooner than later. So if you miss your projections, if you're having major issues, just come out and tell your investors that, or, in our case, tell the platform, and we'll tell your investors. That's really important in managing investors. If you ever want to raise capital again, you need to take care of your investors, because you will get a reputation as somebody. The capital raising world is actually a pretty small world. So especially as you get into bigger checks sizes, you're gonna start to develop a reputation. David, I see some other questions coming in on chat. Do you want me to address some
Yeah,
of those, or what?
there's actually a really good one from Howard Lunan. I think it's
I
important that
see
we
that.
talk about that. He
Mhm.
says, whenever he's looked into crowdfunding, it requires a healthy investment in advertising before a platform will take you on as a client. Is there a workaround for those that don't have the funds to invest in advertising? And there's that. And do you agree with that? I mean, when you talk about, Kickstarter and stuff like that, Kevin mentioned his early things. Yeah, you kind of need to bring the crowd and need to have this momentum. So when your project launches, the platform then does its magic. A little bit different with equity crowdfunding. So I don't know if you necessarily agree with that. I would love both of your views on that. Yeah, please.
So it's very platform dependent. For us, you can come and because have spent a significant amount of our own marketing dollars attracting and building our list of investors who are specifically interested in investing in agriculture related offerings. We're not a generalist platform. We're a niche platform. You don't have to spend a dime on advertising. Now it helps. If you have a pool, like if you have a newsletter or you have a customer list, you have that sort of thing, that can be leveraged. It's keeping within the solicitation rules for raising capital. That everybody should have a email list. Email is now at this point, 40 years into it, is an old tool, but it's still one of the most valuable marketing tools. So build an email list, no matter what you do, what your company is. That's really important. But some companies do require you to spend money on marketing, and not just like making a sharp video, which I think is a great idea. That definitely helps. A video pitch is important, or showing your product in some sort of visual manner, because the internet is a very visual venue for sharing information. But actually advertising, some of these crowdfunding platforms, they have third-party advertising companies that specialize in crowdfunding, and they will do advertising on social media and other places to advertise your raise in a compliant manner. We don't do that because we don't need to do that. That's just not our model. The sort of tangential question about this is cost of capital. So it costs money to raise money. So if you expect people to just hand you checks without making any kind of investment, either paying the fees of the crowdfunding platform, doing that marketing, putting together certain get your company ready to raise capital, you're not going to be able to raise money. These crowdfunding platforms are for-profit businesses. We're not a social endeavor. There's GoFundMe. And you cannot, in case anybody asks, you cannot raise money legally for your company on GoFundMe. I've seen people try to do that. You can't do that. That's a donor platform. But that's not a real equity investment. I mean, you can beg for money, I guess, but that's not an equity investment. So yeah, lots of things coming in. I got a question, saw a question earlier, David, about tell us about raising money for self-directed IRAs.
Yeah,
With self-directed
hang on a
IRAs.
second. Hang on a second,
Yeah, I'm
Chris.
sorry.
We'll come back to that.
Okay,
Kevin,
sure.
Kevin has to leave in just a few minutes. Kevin, do you want to maybe just give your final thoughts, best practices, lessons learned, whatever you can share? Kind of last minute advice, kind of before you have to go.
Sure, yeah. One final book I'll recommend. The number 3 is good, so I'll recommend a third book. The Outsiders. I think the guy's name's William Thorndike, I believe. I'll send a message there. But the CEO as chief capital allocator, and really CEO as investor. And a lot of CEOs, a lot of visionaries, they start companies, and then again, the goal is to kind of get somebody to really do the day to day and be responsible for the P&L. But you need to really be the chief capital allocator. And so for myself, understanding capital allocation from the very start, and investing in assets, especially in agriculture, that is an asset in intensive business. You really want to focus on investments that can turn quick cash, right? So, one thing is we invested in a decent amount of leasehold improvements, right? Which, okay, was probably like a 5-year, cash return, right? And there might have been some inventory investments in beef that we could have made that would have been, 6-month return. So just studying that book, it's the stories of 8 lesser known CEOs in the history of the stock market that actually had the best performance. When you grade CEOs from the companies, they took the best care of the shareholder money and raised the shareholder price the most. When you think of popular CEOs, you might think of, Jack Welch, who's founder or CEO of General Electric. You might think of Steve Jobs, but when you look at their track records, these lesser known CEOs that are actually just great investors and great capital allocators, they did the best, and they weren't necessarily following the trends of Wall Street or doing anything trendy. They were just disciplined investors, and they made each one of their businesses work from a cash and income statement perspective. So definitely recommend that book. And I'm learning and studying how to be a very, very good capital allocator, and definitely and putting all of our capital towards investments now that really, which for us, we've created a lot of demand for our products, and that's really inventory, investing in the quick turns on that, and also ad spend. We do a lot of digital advertising, and we get like a 3x, 4x return on ad spend, and that's a very quick return. So just be very disciplined on your capital allocation, and put every dollar that you put out through a very stringent test, and it's got to meet minimum requirements, or it needs to not be a part of your strategy.
Kevin, thank you so much for being here. We're going to continue with the session with Chris, but Kevin, I know
Great.
you have to go. Thanks.
Yeah, thanks everybody.
Thanks
Good
so
luck
much.
with your
Good luck out there.
businesses. Thanks for having me, David. Thanks, Chris,
Take
again
care.
for inviting me.
Take care.
All right.
Chris,
Hey, bud.
let's get to the chat. There's a lot
All
in
right.
there. You were talking about IRA fundraising. Maybe you can start.
Yeah, sure. Okay, so somebody wants to know, speak about our experience raising funds from self-directed IRA 401k investors. So our platform does allow investors to come in with a self-directed IRA. If you don't know what that is, it's an IRA where the actual investor gets to choose what his investment's in. He's not dropping it into a mutual fund or, a basket of stocks like a 401k that his employer may have chosen. So We see a lot of this in the alternative investment space. That's agriculture, real estate, things like that. People have these self-directed IRAs. We take them. We're sort of agnostic to which platform people will use. There's these custodians out there. Some of them personally are easier for us to work with. Some of them are more challenging from an investor standpoint. And I have a little bit of experience investing through these things. This is an investment advice, but when you use, the reason you do that is to shield your capital gains. And so if you're investing in like a debt deal for us, which would be a slow, steady return, I wouldn't use a self-directed IRA. That's just a personal preference. You got to watch out for the fees in these things because they can be high. If you have a small investment and high fees, it costs a lot of money. So that's my generalities about self-directed IRA custodians.
Have any suggestions on the fintech founder platforms?
I'm not aware of a specific fintech platform. If you're looking on the crowdfunding route, I would look at some of the general Reg CF platforms out there. I mentioned a couple, WeFunder, Start Engine, Dealmaker.
That's
Those
exactly
are
what
good
I was
ones.
going to say. I was going to
Yeah.
say Start Engine, Our Crowd. There's some
hmm
ones out there. But I think
hmm
the lesson learned today is you really got to do some research on the platform. You
hmm
can't be working with multiple platforms, so you might as well spend
Yeah.
all your time figuring out which is the perfect platform for you because as Chris explained, there is one out there for everybody.
Yeah.
What about real
And
estate? Yeah, go for it, Chris.
yeah, what I was going to say is you brought up a good point there, kind of a regulatory compliance point. You cannot have two different rounds going simultaneously. So you couldn't come to harvest returns and raise on a Reg CF platform at the same time. We have an exclusivity clause about that. Now you could go ahead of time. You could raise. We've had companies that have raised a round on WeFunder or Start Engine. I can't remember which one before and then after us, but there's some compliance reasons and solicitation reasons you don't want to raise a round simultaneously because that could be really confusing and get everybody in a lot of trouble if you do that incorrectly.
Right.
Yeah.
Real estate crowd, since you came from that world.
Yeah. So it's funny. So I discovered crowdfunding, equity crowdfunding by investing myself on a platform called Realty Shares, which no longer exists. There's a lot of companies that come and go with various levels of success platforms. It's a hard business. I'll tell you that. Um, it it depends on what your product is. So, um, I think there's some that specialize in debt. There's some that like Ground Floor is one, specialize in debt for like single family. There's others that specialize in multifamily, and so there's a lot. There's probably of all the niches of crowdfunding, uh, of equity crowdfunding, real estate is the largest. So there's a lot of different platforms out there. You could probably Google real estate equity crowdfunding platforms and come up with a pretty nice list.
Yeah, it definitely all started with real estate for sure. They
Mhm.
they, they started the craze. What about do you support organizations from Uganda? I see somebody asked about Canada and you said yes. What about Uganda?
So Uganda, I'll tell you, we have done some overseas raises. In Africa, I've got I love Africa. I've spent a lot of time traveling there across the continent, several different, like dozen different countries. Uganda, we have not raised capital. We did raise capital with a company from Ghana, quite a bit actually. We are not currently raising capital from Africa. I would like to do more. There's some reasons we're not doing it right now, but would love to see some success there. And if you have an idea, just reach out to us if it's agriculture related. If it's not agriculture related, we're not the right platform, but we could at least have a conversation about that. And there are some equity crowdfunding platforms in Africa, almost every continent now. Every region, I'd say, has equity crowdfunding platforms associated with it. So if you're in a different region, Africa, wherever, Europe, the laws are different. So find your local equity crowdfunding platforms there.
Somebody asked for homelessness solution. What platform would be more suitable? I mean, I know there are a lot of platforms that deal with social missions and,
hmm
kind of social
hmm
services and stuff.
Yeah, nothing off the top of my head that I know, but there's probably something out there, an impact related platform maybe. If not that, then maybe like yeah, I don't know. I'm sure there's something out there.
Yeah, for sure. More importantly, what are the fees associated with crowdfunding?
Yeah. Again, uh, very platform dependent. I saw another sort of related question. If I want to raise $1 million, how much is that going to cost
Right,
me?
right.
So I mean, that's a great question. And I think you need to start off by looking at all the pieces that go into a crowdfunding raise. So if I'm just a guy with a company and I want to raise money from investors, crowdfunding aside, first thing I need is an attorney, a securities attorney specifically. So that securities attorney is going to help me put together offering memorandum, which is necessary to raise capital in a compliant manner, regardless of what flavor of raising you're doing, what securities um, exemption in the case of Reg D exemption or registered securities like a Reg CF or a Reg A plus. So you're going to pay a lot of money for an attorney. I've heard, depending on the kind of raise you're doing, that can go well, 10,000 minimum, well into the hundreds of thousands of dollars, depending on how complex your project, your fund is. So that's something to keep in mind. The marketing costs are there. Use a platform like mine, we've absorbed all those marketing costs, sort of amortize them. Um, if you're just trying to if you're trying to syndicate your own fundraise, you may spend thousands and thousands of dollars in targeted digital advertising. And then there's all the other little things that are involved in raising money compliantly, like escrows and investor relations and a platform and DocuSign and all those things. We do all that. We spent that money, so you don't have to. And that's our service. Our fees, our personal fees can range anywhere between the lowest we've done. We've raised over $1 million with 4% cost of capital. Um, we don't like to do that because that was a good bargain for the sponsor. I mean, to raise $1 million and only cost 4%, that's pretty good. Our average range is somewhere between, say, 7 to 12%. The more you raise, the cheaper it is. That's something that is sort of counterintuitive, but if you only want to raise $50,000, I saw a question about that. It might cost 12. Yeah, it could very well cost 12,000, which is, you do the math on that, it's 24% cost of capital. That's a small check relatively to the amount you have to put into it. Now, it depends. When do you have to write that check? Is it upfront or is it coming out of the proceeds of the raise? Those are things to think about. Most crowdfunding platforms are going to have some kind of upfront costs. In our case, it's a diligence fee. And then most of the costs come outside the back of the raise. So that's important to know. To answer specifically the $1 million question, it depends on what your company is. I mean, you could hypothetically go to a VC and that company could write you a check for $1 million without spending a dime up front, but that's very, very unlikely. You didn't get to that place to get a check like that for free. There was things that company did to get the kind of traction to attract attention of an institutional investor. And the same goes with crowdfunding.
And Chris, we'll come back to the chat. We have somebody that has a
Yeah.
question live. Anybody has a question live, just raise your hand. Anton, you're up, my friend.
David, yeah, I appreciate the lecture, the webinar, and can I recommend, like, we've got some fantastic books, and I want to recommend this one, Profit Force.
Profit First, Mike. Oh yeah, of course. Mike
Probably,
McAllowitz. Yeah. So
probably somebody doesn't know it. I just wanted to recommend it. Thank you.
awesome. What else there's one here, Alex Luca, has a lot of financial questions. I love it. Do crowdfunding platforms work with safes, right? The simple agreement for future equity
hmm
rounds or
hmm
similar types of structures. I think you mentioned convertible notes. Maybe you can.
Yeah. So safes are a method of investment that was created by, I think, Y Combinator and Accelerator out in Silicon Valley for early stage companies to raise money. It's very founder friendly, so it's friendly. It's not quite as friendly to investors because there's a lot of intricacies with the way that safe converts into equity and um, and and how it impacts the capitalization table of the company and lots of things like that. So short answer is yes. Some crowdfunding companies do safe notes. We do not. We do convertible, generally on the same terms, very similar terms as you might see a convertible note. But there are some out there that will do a safe round.
And Chris, can you talk about how long it takes? I mean, you mentioned once or twice that it's a long-term thing. This is not happening in 3 weeks, but what's
Yeah,
typical for your platform, which is, I think, is very indicative of like what else could be out there. What is
sure.
the length of of an actual offering that's
So, so you will see some campaigns that stay on some platforms that will stay open for months and months and months. I've seen some over a year, and okay, you can do that. There's a cost involved. I would almost caveat that if it stays open that long, it's not doing well on a platform. Um, there are other platforms where you can literally flip a switch, turn on the investment, and it will fund to the tune of millions of dollars within 24 hours. Now that's the raise itself. There's the lead up to the raise, which is the diligence and that sort of thing. For our platform, that's between the time we have some initial conversations and agree to work together to raise money to the time you have a wire in your account can be anywhere between 90 to 120 days. So again, you know, don't come to me if you need money in 2 weeks from now or you're almost out of money. You know, this is that's just a general. I don't. Another thing you'll hear a lot in the investment world, VC world, is don't raise. The money is easier to raise when you don't need it. When you need it, it may be too late. So if you're even thinking about, you know, maybe I should raise money for my company, start talking to people, you know, 6 to 12 months ahead of time. May not take that long to do the actual raise, but then at least you can kind of lay out your options.
awesome. Chris, can you just in the interest of time, can you give
Mhm.
people some like I don't know, you mentioned red flags, which I think is great, but just like mistakes made, lessons learned, kind of what we asked Kevin, final thoughts. You know,
Yeah.
that
Lessons learned. Don't, you know, this investing is about negotiation. So be prepared to negotiate your valuation, negotiate your cost of capital. If you're talking to a platform, negotiate, you know, the timelines, all those things. And negotiation is very, very important. Um, don't be surprised
mistakes
if
made,
no one in, what's that, David?
mistakes made by people,
Mistakes.
by entrepreneurs.
Um, coming in with too high a valuation, if you're doing an equity round, is probably the most common one. Um, trying to raise money too early, that can actually work against you. So if you do a crowdfunding raise and it doesn't do well, or you talk to VCs or whatever, it doesn't do well because you came in too early or unprepared, that can actually hurt you down the line. So it never hurts to have conversations. And if somebody won't talk to you collaboratively, either an attorney or a crowdfunding platform, then you probably don't want to work with them. So if you come to me, I'm going to give you feedback. We may not agree to work with you to raise capital, but we'll give you some feedback. And the further along you get in the process, the more feedback you're going to get. You know, the ultimate feedback is you have a successful crowdfunding campaign, or from highly successful to marginally successful. That's kind of the ultimate measure of feedback.
Awesome. Okay. I think we're probably gonna bring this to an end. There may be one or two questions we didn't get to in the
Mhm.
chat, but in the interest of time, we're gonna end. I wanna just say a few things. Chris is actually Chris. I think I told you about this, but Chris is actually one of the authors on a new book that myself, him, and about 7 or 8 other authors have written together called Marketing Your Invention. And it's all about the different ways that people today market their inventions and products and services. And crowdfunding is one of the chapters because it is definitely a way to market as well. So that will be released shortly, and we'll let everybody know about it. So thank you for your contributions there, Chris. And a lot of the nuggets you heard will probably be there, and much, much more. Second, our next entrepreneurial strategy series will be the last Thursday of January, and it is all about valuation. Why, God, I think valuation was brought up in every single ESS we had this year in 2024. No matter what the topic was, we talked about valuation. How much is your patent worth or your trademark worth, my company worth? What are these numbers? Are they real? Should I make them up? Is it monopoly money? Whatever the situation is. And we have some valuation experts that actually do this for a living that will be on to share their knowledge. So look out for that. This whole session was recorded. We will share the recording with all of you that registered. And in that, you'll also maybe get some contact information for Chris and Kevin. So you can possibly reach out to them directly or however they choose to have you reach out to them. I want to thank you all. Thank you, Chris. Thank you, Kevin. Thank you for an awesome webinar. Happy holidays to everyone. Happy New Year to everyone. Thank you for coming out. Thank you for supporting, and we will speak to you soon. Take care, everybody. Bye. Thanks, Chris. Bye-bye. Bye-bye.